So with the practice problem, you do want to remember that it's due Friday night, even though it appears several of you guys have it done, and that it doesn't matter what you put for 11A. Either leave it wrong, enter in the 4 as the ending. What did I say it was? 11,224. But it should be the same as 11. 11 and 11A should be exactly the same number. But I won't count it wrong. So if it shows up wrong, then don't worry about it. I will round up. And even if you end up being off by number, it's worth 15 points. You end up with 14.75. That's gonna be a 15. I do round up. I don't want the grade book with a whole bunch of little point something. So if you end up with 14.75, you're going to end up with a 15. Okay? So I do round up when it comes to that. Okay. James, you good?
Yeah. One other thing. So on this, since everything was just in straight dollars, there's no reason to put
no decimals. Nope. And actually, the government does not want your decimals either. When you do your tax return, they won't do it. If you use most computer systems to do your taxes, it's going to round it up. Okay, so chapter 6, we're going to actually start talking about some of those deductions and losses. So we've talked about income that's included. We've talked about income that's not included. So today we're actually going to talk about those deductions and losses in general. Okay, so at a high level. So that only means that we're going to keep talking about them in other ways as we keep going. So there's never just one thing, right? There's always a whole bunch of different ways of looking at these numbers. So this is a very big picture of Dr. Cliff Payne and a whole bunch of his items that he has associated with his dental practice. And if you look down at various things, he has his salaries. And notice it says we have FICA, $5,000 of salaries are not paid. And then we have a whole bunch of things from rent to dental supplies to investigation expenses. He has contribute to a couple of Senate campaigns, a lawsuit, dues, and then he drew on it for some living expenses as well. And then in the end, we're going to get a number, and he wants to know if he calculated his expenses for his dental practice. So we're going to be looking at his business expenses, but we're also going to be looking at itemized deductions at a high level. So exclusive definition, deductions are allowed based on what we call legislative grace. And the last year has been a perfect example of legislative grace because the legislative has decided to take away some of the things that we have had and give us some other things increase that we didn't have, all right? And how they decided to do that? At the grace that they decided to do it, all right? It was their decision to do it. It wasn't a vote, it wasn't anything else, it was just their decision to make these changes. All right, we have, and this is very important for you to remember, whether you are doing taxes or you are just doing your own taxes. Unlike our judicial system where we are innocent until proven guilty, on the IRS side, you are guilty until you prove innocent. All right? So when you turn in your taxes, the burden of proof is on you to give the documentation. So if you turn in a tax return and you are audited in any form, you must show them why you are right. It is reverted back to what they believe until you show them why you are right. If you are given what they like to call an office audit, which is the worst type of audit that you want, that's when they come to you and they like to sit with you and go through all your stuff, you must be able to provide all the receipts. Right? It is not the type of audit that you want. You need to be able to have all those receipts. And basically, when we're doing the VITA, which we're allowed to show that if we believe them, we can do it. That is the one thing we tell them every year. It is up to you to provide these receipts. It is up to you to be able to show that you gave these donations or you did this. Can you show that? Yes, I have all of them at home. I just did not bring them. All right, as long as we believe that they are telling the truth. So we're going to kind of take a little flashback here for a second. Deductions for AGI. All right, we claim these whether or not we are itemizing or we are not. All right, and if you remember, our deductions for AGI, we'll see how easily we can swip back and forth on our screen. So we're looking at the 1040 Didn't I say quickly? There we go. Or not quickly. We're looking at the 1040 and we're trying to see, one more time, there we go. As a reminder, looking at the 1040, AGI deductions for AGI are going to come before line 7. So where are all those deductions coming from? Now, when I talked about them last time, I did not have the form printed out. This time I do. They're coming from, let me shrink this up a little bit. They're coming from Schedule 1. So if you don't have a Schedule 1, and you're not in class, you want a Schedule. So a Schedule 1 is called adjustments to income, all right? And unlike years before where you could just have a 1040 up, you now need to have a 1040 and you need to have a Schedule 1. And I really think it's important to be looking at these forms while you're doing these chapters so that you can be comparing them and looking at them. So the Schedule 1 line 1 through 22, I apologize, are additional income, all right? This is all income and we'll come back to this. These are all lines that are going to add to our income, all right? So if you specifically look at lines 11, 12, and 13, actually add in 10. 10, 11, 12, and 13. Those are very common lines, all right? 10 is taxable refunds. We'll talk about that. Alimony we've already talked about. And then business income and capital gains we will talk about a lot. All right. If you go down below that, adjustments, we are going to talk about those today, 23 through 35. All right. These are all going to be adjustments for AGI. That means things that will reduce our income prior to AGI. These happen with or without our standard deduction versus itemized deduction. These happen regardless. So look at some of these things. Educator expense, we'll talk about that. Certain expenses for reservists and performing artists, not very common. Health savings account, moving expenses. Notice we talked about this last week, only for the armed forces now. Deductible part of self-employment. Then we got self-employment for SEP, self-employment health insurance deduction, alimony paid. Again, we talked about that last week, only for those prior to 1998. Did I just say that? Prior to 2018. Student interest deduction, and then IRA deduction. So those are all going to be things that we are going to look at, and then that number from line 36 we will transfer over. So let's go back over to our PowerPoint. So those are deductions for AGI. Now the other deduction we have is going to be deductions from AGI. All right, those will happen after that. And the biggest thing here is going to be deciding between standard deduction and itemized deductions. Right? There's certain deductions and itemized deductions that are going to have to exceed a limit. One of those is medical deductions. That's going to have to exceed 10% of AGI. So if we come back over here, again, it's going to make me mad if it's going to make me, there we go. So we're looking at our 1040. Our AGI is line 7. That number is very important. So line 7, we've got the number from 6, which was our line, that schedule we just looked at. It helped us come to line 7. So now that AGI number is going to help us calculate and come to our numbers if we're itemizing. Right? So everything coming into line 6, that AGI number on line 7 will help us determine if we're going to itemize possibly, and then if we're going to take the standard deduction. All right, so the numbers we're going to talk about are going to be this, what goes into line 8, and we're also going to talk about QBI, which is the qualified business income deduction. Those are the last two deductions that we're going to talk about. All right, so we know that those are called below the line deductions because they They must exceed, and the itemized deduction must exceed the standard deduction. So let's look at a little comparison, how these affect things. So notice when we have a $15,000 for AGI deduction, it reduces our AGI, right? So now we're down to $30,000. Now we have to take, we take a $12,000 from AGI, it ends up with $18,000 of taxable income. If we have only a $15,000 from AGI deduction, we end up with $30,000 of taxable income because it exceeded our standard deduction. So we took it over standard deduction, but we didn't get to take it for. So if you get a for AGI deduction, that is better than necessarily a from, because then you can get the for AGI deduction and you get the standard deduction. But if it's only a from, then you get the standard or the from. You don't get the both. So the first one is definitely a better case scenario. We're getting taxed on an additional $12,000 here. Now, you don't get to choose that, all right? The example is just showing you how having the benefit of having 4 AGI deductions is a big benefit. So here's a list. Again, we kind of went through these, so we'll go through them fast. Keeping in mind, alimony is suspended for anyone who gets divorced after 2018. A few more items here. Moving expenses also. Does anybody know what, because I went over it briefly here, what the $250 for teacher supplies includes? Okay, it's a good thing we mentioned it. So, if you teach K through 12, it does include pre-K. K through 12 pre-K, you are allowed a $250 for AGI deduction for expenses that you have in your classroom. All right. So, do you need receipts? Answer, yes. Do they have receipts? Answer, somewhere. Okay. I can honestly tell you I do not know a K through 12, more specifically a pre-K through 8, but K through 12 teacher that does not spend $250 in their classroom. So usually they usually spend more than that. It just doesn't exceed the other limit. So in most cases, now there are teachers that are not aware of this. Right? Not a lot, but there are, and it's usually those that do their own taxes, unfortunately. But up until 2 years ago, this wasn't a line item. It was line 23, and it said other. And it officially became an item 2 years ago, and then the tax form, the old tax line, changed. So more and more people are becoming aware of it. So it's for teacher supplies, elementary, and secondary, not me. All right? But I also don't spend the money. I might spend $250 to be honest, but not all the time. Teachers in K through 12, they spend way more than that. They're buying Kleenex for their kids, which is sad. All right. And then this one right here, penalty on premature withdrawal from savings accounts, that is not IRAs. That is when you go literally to savings accounts, things that you have at the bank's account. Not when you spend 1% penalty for early withdrawals. That is not the same thing. I will show you where that goes because that's when you pay it. All right, itemized deductions. So this is a partial list. And in a second, we will go over the Schedule A. So medical expenses, 10%. It was 7.5. It was 10. It was back to 7.5. It is at 10. It really is at 10. Last year I started talking to VITA. The whole fall I talked about 10%. VITA started in January. It was 7.5. December 24th, it went back to 7.5. I about fell over. It's back at 10. All right? It is 10% for everybody.
You said VITA?
VITA is the Voluntary Income Tax Assistant Program that we run here at the college in the spring. All right, that's a program where you come in. It's an internship that runs on Wednesday afternoons that you sign up and register for, and we train you on how to do taxes. And then about 6 weeks into the semester, you start doing taxes for the low-income and elderly and students as well in the spring. So 10% of expenses for medical. Now that's important because that is for medical expenses that exceed 10% of your AGI. People get confused about that. So the way I explain it the easiest, if you make $100,000, your medical expenses have to exceed $10,000. So if you have $11,000 of medical expenses, you get to deduct $1,000. I also try to explain it to the students as this. Usually it's elderly, those with no health insurance, and catastrophic problems, all right? Because typically someone who's working with insurance does not exceed 10% of their AGI.
Right.
All right, certain state and local, that was affected. Remember, who knows what our cap is? What's the problem now with state and local taxes? I don't want to say problem, but I consider it a problem. There was a change. You can itemize, but only. Okay, that's always been. You can take income tax or sales tax, but there's a change now that you can only take all of your taxes, and they can only amount to. It didn't affect your practice problem, I guess. No. Okay, all of your taxes cannot exceed $10,000. So, for example, you have real estate taxes, you have personal property taxes, and you have your state income taxes and local, depending on where you work. All of those, husband, wife combined, cannot exceed $10,000. So, we'll talk more about that in a second. Personal and casualty losses, they don't exist anymore, but they used to be included. Certain personal interest expense, mortgage, that includes, but you do have to, if you have a second mortgage, it does have to be exclusively to the house. And then miscellaneous itemized deductions no longer can be done, but those also used to be itemized deductions. So they are modified, they're suspended right now. Yes?
Quick question on that state and local taxes.
Yeah.
So if it exceeds $10,000, you can't deduct anything?
No, you deduct $10,000.
Deduct up to $10,000?
Yes.
Okay.
Yeah. So let me, here it is, okay. See how many clicks it takes. It seemed to want to take 2 clicks every time. All right, so here is a Schedule A, which I honestly believe, I would also print one of these if you're not in class to get one a copy. However, one of the reasons most of us believe that the changes were made in the tax law is because they're trying to make it easier to do taxes and a little more, this isn't the right word, but cheat-proof, okay? So that everybody's on the same playing field. One of the easiest ways to put things on your taxes that may or may not necessarily be 100% legit is itemized deductions. All right, so if we limit itemized deductions and make people not take them because the standard deduction is so high, then we limit it. It also makes things easier on the IRS because if people aren't itemizing, you don't have to look through as much paperwork, which limits audits, right? So in a way, we're trying to make things easier. I get all that. All right, that makes a lot of sense. However, some of the things they limited didn't make a lot of sense. So I want you to look at, if you're looking at the, I'm going to make it bigger, so we'll just do it in sections. So the very first part is medical, all right? We will go in a lot more detail, but medical is broken out, and if you notice, this is still the 2018 form because the 19 form hasn't been released. So there's a couple things that are different. On that form, up on line 3, it says multiply by 7.5. That's going to say multiply by 10, okay? But not all the 2019 forms are out. All right, so that would go here. Then this is the form, section 5 through 7 I want you to look at. So 5 says state and local taxes. That's going to be how much tax is taken out of your paycheck. Well, that depends on how much you make, right? So depending on what you make depends on what goes there. So if you make, and I don't even necessarily know what Missouri's, this is horrible, what Missouri's tax progression rate is because we don't cover that, so it's not something that I keep at the top of my head, right? It's like, is it 10%, 15%, 20%? But I can tell you that it's drastically less. But even if you're looking at someone making 100 grand who might have something like 7%, I think is a reasonable guess, that's $7,000. $7,000 in state, and that's a single person, all right? And let's say their spouse makes 50. So then let's say we'll take half, $3,500. That's their state and local taxes, all right? Their real estate taxes, if you have a $250,000 house in Melville, your real estate taxes are probably going to be somewhere around $2,700. And I'm in Melville, all right? So that's going to be lower than if you're in anywhere else in the county and higher than if you're in the city. Then you come down here and you got personal property tax. A couple cars. I just said you're making $150,000, so you probably have a couple of nice cars. That's not counting the fact that I have 2 kids that are in a car. All right. That's $13,900. Right off the bat, I can only claim $100. So $3,900 just got whacked out that I can't claim. That's for someone with very reasonable real estate taxes, considering they're making $150,000. More than likely, that's probably closer to $5,000. So if that's the case, they got $5,000. So right off the bat, their itemized deductions just went down $5,000. Now, we're in Missouri. This really hit hard on some of the coastal states. New Jersey, New York, and California had a heart attack when this first came out because they wanted time to try to implement it because their real estate taxes are astronomical. Their real estate taxes are alone over 10 grand on places that aren't even anything like our houses. And they just got capped. And so when you take this all of a sudden out and you cap this at 10, then you come down here, you got your mortgage. Now mortgage has a couple different things. You can have first and second as long as the second was used towards your home. Then you have your charity. And then you have your casualty and theft, which now is gone, but it was still on here. So that's when you're not reimbursed. All right. Then there was another one that's not on here anymore, but it was miscellaneous itemized deductions. Now, it took a lot to be on there, but the people that were usually had that on there were people that had were reimbursed for mileage that weren't reimbursed from work. And that's gone now. So if you drive for work, but your work doesn't reimburse you, you no longer can deduct that. And that has hit some people hard. All right, so that's no longer a deduction that you can do unless you're a business. All right, so if you're a business, then it goes under your business deduction. But if you are paid by a W-2, you cannot deduct that anymore. And that's not a good thing. So that $5,000, $4,000, $6,000, whatever it would be. I know people that had $11,000 shaved off their itemized deductions. And they used to have $40,000 in itemized deductions. So it still made sense for them to itemize, but that means they're taxed on an additional $11,000. And if you couple that with the exemptions being gone, and they had 3 kids, they have another $20,000, $24,000, plus $35,000 of taxable income. Now, they did have the additional child tax credit, so that did take a little bit of the sting off. But things did not necessarily equal out, I think, the way that some things were planned. Non-intentional, but it didn't necessarily equal out. Did it make some things a lot easier by the IRS? Absolutely. Did it take some loopholes away? Absolutely. I'm just not sure how the $10,000 was come up with. People ask me that all the time. I can't tell you. I have no idea where the $10,000 in state and local taxes. It does seem very low to me if you have a 2-family. It seems like $10,000 state and local income tax for whether you're single or married does seem like a low number. It would seem like there'd be 2 different numbers whether you're itemized as single or and there isn't. So I can't answer that one. So let's get back out of here. And move on. So then we also then have trade or business. Now, as I kind of led into with the mileage, so if we have a business, Section 162 allows us to deduct all ordinary and necessary business expenses that were paid or incurred during the trade or business, including wages, including anything expenses for business, and 1/2 of self-employment taxes. All right? Those are deducted for, because remember when I showed you on the Schedule 1, I'm not going to flop it back up there, but when we had the Schedule 1 in front of you, I think it was line 12, that says business income. In business income, now we'll have a whole chapter on business income, but when you put business income, the expenses are deducted right from that. So it's all done in that same line. So when you show business income, it already deducts business expenses.
How do you remember all those?
How do you remember all your expenses, or how do I remember the lines?
Or do you remember all lines and numbers?
Doing it too much. Doing it too much. Just doing it too much. Okay, so for expenses to count, number 1, they have to be ordinary and normal. All right, normal expenses, customary. Everybody that does your type of business has to have those same expenses. All right, they have to be normal for a prudent person to do, reasonable, and incurred in your business. So you can't be sitting there and flying to Hawaii to talk to somebody in, I'm trying to come up with some wacky, you're in a plumbing business, but you got to fly to Hawaii to go talk to somebody regarding some plumbing installation. I mean, that would not be considered reasonable. You should be able to talk to somebody, I would think, somewhere locally in the United States if you live in the middle of Missouri, right? But at the same time, if you're some geological expert trying to study the earthquakes in Missouri, you might have to fly somewhere else to do that same type of work. So you got to look at what's considered reasonable. All right, now this one's a little different. This is Section 212. This is the production of or collection of income. Not as common. This is not normal business. All right. So this is management, conservation, maintenance of property in the production of income. So you're producing something that produces income. This is a little bit different. And this is expenses paid in connection of determining or collection refund of any tax. So Section 212 is a little bit different. It's not quite the same thing. Expenses that are deduction for AGI, any type of rent or royalty. So this is rent or royalty. This is Schedule E. Same line, Arden. Same line, different form, okay? And paid in collection, so you're collecting the money for rent or royalty. Now, royalty can be a little bit different, though. Royalty can come from things like book revenue, painting revenue, but it also can go drastically the other way, and it could be from like oil refinery and revenue, oil fields. And I know that's funny, but I do someone's taxes who family owns just a couple things over in Illinois, and every once in a while they have a K1, they have a partnership, and she gets a little oil revenue. It's just straight. I laughed the first time I did their tax return. I said, "You guys have an oil field?" But it's just one of the ones when you drive through Illinois. Every once in a while, you see one of the little oil things pumping. It's one of those little guys. But that's royalty. The expenses are itemized deductions that are not directly related. Are going to be deductions from. But most of them you'll be able to find directly related to it. But the reason a lot of them aren't directly related to it is because if it's not determination with the collection of the money, then it's going to be something like a safe deposit box or something like that, and then it would be an itemized deduction. However, some of those are no longer allowed, like the safe deposit box. You cannot deduct the safe deposit box costs anymore. All right, now you can have a business loss. You cannot have a non-business loss, except for you used to be able to have casualty losses, including shipwreck, in case you're shipwrecked, but you can't have that anymore. All right. So deductible losses for individuals are those limited to trade or business or any transaction entered into for profit. But you cannot deduct casualty losses anymore. You can get help for a federal declared disaster area. Now this one was its own line. Okay, remember I said this one has its own little line? It comes after, and this one I actually have to look because this is new and it didn't used to have its own line. It's on our, it's on line 9 of the 1040. It's QBI. And that's because this is actually something that's been added. And it was kind of interesting when I was in